This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The influence of the accounting profession is immense. You just have to look here at the type of work that accountants get involved in. There is financial accounting, doing the debits and credits within an organisation, producing the annual financial statements. You could be an auditor, someone who is basically checking on someone else's financial statements. You could be management accounting, more involved with budgets and looking at the profitability of items and decision making. Consulting, perhaps consulting on methods of internal control or what the effect might be of subcontracting some elements of the production process. Calculating the tax, minimizing the tax. There's public sector accounting, very important for government and local government authorities. That taxpayers' money is properly looked after and the taxpayers get value for money. The types of people who use the information produced by accountants, managers of the company, shareholders, trade contacts, suppliers and customers may want to know how financially reliable you're likely to be. If you are being asked to put in share capital or to lend money to the company, then you'd be interested in seeing the latest set of financial statements to see if it seems to be a good investment opportunity. Inland revenue or the taxation authorities. Employees of the company may be interested. They will also be worried about their job security and job safety, and they may well want to see that the company is reasonably profitable. The press, financial analysts, advisors, where should you put your pension funds and or your savings and so on. Government and their agencies. We have the inland revenue, of course, but then the government is also interested in knowing, how much revenue is generated, let's say, by the aerospace sector in the country, or how much is generated by the film production set up within the country. Because you can't really plan for governing the country unless you have some idea, some feel, if you like, of the elements of the economy. And of course the public. We like to know sometimes how a company is getting on, what sort of profit it might be making, whether it's a safe company to go to when we're booking our holidays. Now, this variety of people using information and, of course, the influence of the accountancy profession that we've seen implies really that we ought to have some sort of regulation over accountants so that the work they do is of high quality and can be relied upon. In many ways, this is our ultimate selling proposition. We will never get a good salary or earn good fee income if nobody actually believes what we're doing or what we're saying or what we're calculating. So if we're going to be worth anything, if we're going to be adding value as accountants, then we need to be properly regulated. And first of all, there are ethical codes. We must be confident that when somebody produces a set of financial statements, that they do this as well as they can, that they're not artificially inflating figures just to look good, that they are being honest about what is being reported. So we have IFAC, the International Federation of Accountants, produces a code of ethics, and all the members of IFAC, of which ACCA is a member, really have to adopt this code of ethics in some way or another, and it is essentially adopted wholesale by the ACCA in their rules and regulations. And it states that the accountancy profession must act in the public interest. We've talked about public interest. It means trying to do right for stakeholders and the public as a whole, and certainly any form of dishonesty or distortion of financial statements would not be doing that. The way it works is that the ethical codes set up 5 fundamental principles, which we'll see. It recognizes that these are subject to threats. Things will be kind of pushing away at these fundamental principles, trying to get you maybe to depart from them. And it's really a matter of being forewarned as forearmed. If you know there are certain threats, then what we can do is to maybe avoid those threats entirely, or to employ safeguards to reduce the threats to an acceptable level. So the 5 fundamental principles are these, and it's very important you know these. So integrity is a form of honesty, but more than honesty. It certainly involves honesty, but it also means standing up for your beliefs. So if you were asked to produce a budget, you produce the budget to the best of your ability, and your manager says, no, I want double the profit, and you can't see any way that profit could be doubled, other than through some sort of miracle, you really do believe the budget, then you're facing an issue of integrity. Should you be producing fiction, which you believe to be fiction, you know to be fiction, and then this is given to the bank to induce the bank to lend you money. So you should be, willing to stand up for your beliefs, and in serious cases it may mean that you have to go and seek advice from ACCA or whoever, and it may mean in very serious situations that the breach of integrity is so great that really you have to resign your position. Objectivity. You must concentrate on the evidence which is there and not let outside influences distort your judgment. Professional competence and due care. It means keeping up to date. It means knowing the latest accounting standards. It means spending enough time on preparing reports and financial statements and so on. It means not starting to do a piece of work where you have no competence, where you've had no training, no experience, where in many ways the figures you're producing are little better than random. Confidentiality. We are very privileged as accountants to see all sorts of interesting information, confidential information. You may see everyone's salary. You may see next year's budget. You may see how the company's done this 10 months and therefore have a jolly good idea how it's going to go for the whole year, maybe making much more profits than anticipated, which would imply a share price might increase once those profits have been released. And you have to hold information confidentially. There are certain times when you can release it. If you're given express permission to release information, you can do it. If you have to defend yourself against some sort of accusation in a court of law, you can do it. And then sometimes there is a duty to disclose confidential information, particularly in law breaking and particularly in money laundering, where in the UK accountants are required to report any suspicions of money laundering to the authorities. And finally, professional behaviour. We mustn't do anything which brings the profession into disrepute. For example, we mustn't in our advertising literature say that some other company is a useless firm of accountants. This brings the whole level of the profession down, if you like, and we must be careful not to do that. Accountants get involved in producing both management accounts and financial accounts. Quite different. Management accounts are used internally. The financial accounts are what goes externally, once a year normally, to the shareholders. And it's financial accounts also which are likely to be registered with the government authorities who look after companies. So, management accounts, you can do anything you like really, because they're not subject to any regulation. There can be any format. You can produce your budgets monthly, weekly, daily, annually, doesn't matter. You can do a budget for the statement of profit and loss and not do one for the statement of financial position, if that's what you want to do. They often look forward and back, say, here's how we did last month, here's how we think we're going to do in the remaining 3 months of the year. Often ad hoc, meaning you could be asked to do a special sort of investigation into the profitability of a certain product. You do that once and may never be asked for again. There are, of course, routine production of monthly management accounts, but there's quite a lot of specials, if you like, within the management accounting sphere. It's not governed by statute. You can do what you like, and it's not subject to audit. There's no independent checking, or certainly no statutory requirement for independent checking. The management accounts are used, as it suggests, by management for planning, for measuring how they've been doing, and anything which is useful to management can appear in management accounts. Financial accounts are the accounts which go to the shareholders once a year normally. This is the shareholders' kind of one opportunity, I suppose, to see how their investment is faring, whether profits are up or down and so on. These are very closely regulated by law, how they should be set out, what should be disclosed. For example, it will specify that directors' remuneration has to be disclosed and so on. They're always looking back, what happened in the 12 months ended 31st of December. They are absolutely routine, really pretty much the same format every year. You have to comply with statutory and accounting rules. You have to display the information in certain ways. You have to label information in certain ways. You have to treat certain forms of asset, if you like, or liability in certain ways. Otherwise, they are simply wrong. And nearly always are subject to audit. Only in the very smallest companies will there be no audit. Certainly once a company is listed on the stock exchange, it's going to be subject to an independent audit by independent external auditors. And we'll see a little bit more about that in a moment. The audit is a way of giving some assurance to the shareholders that the financial statements they are receiving are not a complete load of fiction, that the directors are properly reporting what actually happened in the accounting period. Audit. So auditors come in, typically maybe 4 weeks in a year, usually 2 weeks during the middle of the year and then 2 weeks after year end. And what they will do normally in the first 2 weeks is they go through the accounting system looking at the operation of internal controls. We'll see what internal controls are in a later chapter, but basically internal controls are there to try to ensure as far as possible that information is recorded properly, that assets are safeguarded. So you'd expect to see as a simple internal control, if you work some overtime, your manager authorizes the extra hours rather than you authorizing it yourself. So this work done early in the year, sometimes called an interim audit. Auditors sometimes find that the internal controls are not operating properly, and then they will write reports to management showing where internal control has broken down, where it could be improved, and so on. At the end of the financial period, when the company produces the financial statements, the auditors go back in. It's usually called a final audit, and they go through, basically think of going through every figure on the financial statements and getting some evidence to support the idea that this figure is correct. Now, correct is not a word they use, but it'll do for the time being. The financial statements consist of the profit and loss account, the balance sheet or statement of financial position, as it's more properly called, the cash flow statement, statement of movement and equity, and supporting notes. So those 5 elements make up the financial statements. The auditors do not report on the director's report. The auditors do not report on the chairman's statement. Those are outside the financial statements, even though they might be in the same glossy booklet. What the auditors do is they do not prepare the financial statements. They do not double check every transaction, because that would be economically so expensive to double check everything. They do their work on a test basis, and then they give reasonable assurance. They do not give guarantees. If you're doing work on a test basis, you can't guarantee anything. You do your work on a test basis. You maybe look at 50 invoices, how they were authorized. If they're authorized properly, and there's a good system of internal control, you can kind of rely on the other, 20,000 being authorized properly. And they report on whether or not the financial statements show a true and fair view. So true roughly means pretty accurate. The numerical amounts are pretty good. Fair is harder. Fair kind of means, is it presented in a way which is not misleading? Okay? Because it's possible to have the right figures underlying the financial statements, but if they are presented incorrectly, labelled incorrectly and so on, the financial statements could still be overall misleading. The regulatory system of producing financial statements and for carrying on an audit is first of all governed by company law. So it will state that every year you have to produce a set of financial statements. It consists of certain things. Every year it has to be audited by independent auditors. But it doesn't, in general law, doesn't get into huge detail about maybe how you show leases in your financial statements, or how you show pension deficits in the financial statement. These are very specialist areas, and the parliaments don't get into that too much. So what you have is something called the Financial Reporting Council, and in the UK, the Financial Reporting Council. Other countries have got other bodies, like America, I think it's the Securities Exchange Commission and so on. And these bodies go into much more detail on how financial statements should be presented and how they should be audited. So in the UK we have the Financial Reporting Council. It has within it the International Accounting Standards Board, and that, as the name suggests, the IASB is responsible for determining international financial reporting standards. These are how you would show certain pension liabilities, how you show leases, how you show long-term contracts, how you deal with research and development expenditure, and so on. There is also the International Auditing and Assurance Standard Board, and this governs how audits should be carried out. And it will give almost instructions to auditors. If you want to audit this properly, this is the sort of evidence you should be looking for. So the idea is that because of these are international standards here, really coming from IFAC and in the UK implemented through the FRC, these international standards mean that any country subscribing to them, they will be presenting the information in international understandable ways, and the audits should be performed according to kind of an international standard, giving much more reliability in financial statements coming from all over the place. There's the International Ethics and Standard Board of Accountants. These are the people who talk about the 5 fundamental principles, integrity and so on, and they give information about how you should avoid threats that may be present that are going to be attacking the application of these principles. Now everything so far in there is all to be really doing with accountants, and the trouble is that it can be a bit inward looking, and accountants are not the only people who look at financial statements, a lot of other people involved, like investors, like pension funds, insurance companies, the government. And so what we have over the IFAC is a Public Interest Oversight Board, and the Public Interest Oversight Board has got representatives from major users of financial statements, pension funds, insurance companies, investment companies, governments and so on, and they can give some input as to whether or not they think the solutions that has come up about, let's say, financial reporting standards, whether they've come to a conclusion and a rule which is actually useful for the wider users of the financial statements. There's also something called GAAP, Generally Accepted Accounting Principles, or Generally Accepted Accounting Practice, depending which country you're in. It's a set of rules governing accounting. It's a bit of a mishmash, some of it coming from company law, some of it coming from accounting standards, some of it coming from international accounting standards, some coming from stock exchange requirements. And this kind of basket of rules, if you like, is usually what the financial statements eventually comply with. Internal audit. Now, we've talked about external audit. These are the people, the independent people who come in and go through the financial statements, getting evidence that each figure is true and fair. We also have internal audit. Internal audits are employees of the company, and their job is to provide independent assurance that an organization's risk management, governance, and internal control processes are operating effectively. So what management has to do, what the directors have to do, for example, is they have to set up internal control. You have to say that if you're doing overtime, then we expect your manager to sign off the overtime. They're also responsible for identifying risk areas where in our organization could things go wrong. So if you're in an organization like a jeweler's, then of course inventory is greatly at risk. I mean, small, high-valued items, diamonds, gems, and so on, are going to be an area of huge risk of theft and so on. So management should be recognizing the risky areas and applying sufficient internal control mechanisms, particularly to address the risky areas. What internal audit does is to make sure that, as far as I can see, the risk areas have been properly identified, make sure that the internal control processes appear to be comprehensive, and also to make sure that the employees are actually doing it. It's all very well saying you have to have your overtime signed off by your manager, but if your manager has become lazy and says you sign it off yourself, then the internal control isn't working anymore. So what internal audit do is they spend all of their time really going through and making sure the internal control system is operating properly. Now, I said all of their time. They sometimes have special jobs to do. If a fraud had been discovered, it might be internal audit to investigate who did it, what was lost, how they did it, how to stop it, and so on. But most of their time is going to be making sure that internal control is working properly. They differ from external audits in terms of the following. First of all, appointment. External auditors are appointed by shareholders. They report to shareholders. And internal auditors are appointed by management and they report to management. It's very important for good corporate governance that external auditors are independent of management, are appointed by shareholders and report in their audit report to shareholders. Employment. Internal auditors are employed by the company normally. External auditors are by an independent employer like PwC or KPMG or any large firm of accountants. The scope. Strictly internal audit can be given work to look at anything. Look at value for money. Look at efficiency. Look at the fraud. And look at the operation of internal control. The scope of the external auditors is very much really to be able to give an opinion on the financial statements that are operating true and fair, that they're being displayed in a true and fair manner. Finally, determination of work. It is management who determines the internal auditor's work. They say do this, do that, don't do that. For external auditors, it is really the law. They are required by law to come to report in a certain way, and by law they are given the right to see any document they want and to ask for any explanations they need. It is not possible, for example, for management to say to external auditors, no, you can't see that contract because it's confidential, or you can't see those board minutes because they're confidential. Because of the seriousness of this independent reporting that they have to do to the shareholders, external auditors have a statutory right to see any information, any documentation, and to have all explanations that they require to carry out their audit.